On many brokerage statements, you might see an amount in this column here and wonder, what are wash sales and why are they disallowed? This video is going to attempt to answer that question for you. I'm the Tax Geek, and here are wash sales, oversimplified. First of all, if you're unfamiliar with stock sales, capital gains and losses, or brokerage statements, there's a whole playlist that explains them, which you might want to check out before watching this video. Wash sales occur when the same, or essentially the same, stock is bought and sold repeatedly to generate a string of losses. Let's just say you purchase 100 shares of ABC Corporation at $100 per share. 2 weeks later, the value of the stock drops to $75 per share and you sell it, generating a $2,500 capital loss. A few days after that, the value of the stock rebounds to $95 per share and you purchase another 100 shares of it. Within a few days, the stock drops back to $80 per share and again you sell it, generating another $1,500 capital loss. Theoretically, this could go on forever, generating a string of short-term losses that could be used to either offset a capital gain or even other income. Thus, the wash sale rules, which are designed to prevent this sort of behavior by not allowing such losses to be used in that way. According to the IRS, a wash sale occurs when the same securities are purchased either in the 30 days before or the 30 days after the sale transaction that generated the original loss. If replacement stock is purchased within 30 days of the original wash sale, the disallowed loss is then added to the basis of the replacement stock, essentially deferring the loss until the replacement stocks are sold. If replacement stock is not purchased within 30 days, the disallowed losses offset any other capital losses claimed that year. If there is an overall gain, the disallowed wash sale will serve to increase that gain. Let's go through this step by step with an example, using the same figures from before. Meet Janet. She has an investment account with Big Brokerage and frequently trades stocks. On April 1st, 2023, Janet purchases 100 shares of ABC Corporation at $100 per share. Her basis in this stock is $10,000. 2 weeks later, on April 15th, 2023, Janet sells her ABC Corporation stock at $75 per share. This results in a short-term capital loss of $2,500. Since she purchased the stock less than 30 days ago, this is considered to be a wash sale. Then, on May 5th, 2023, she repurchases another 100 shares of ABC, this time at $95 per share. To the $9,500 basis, she adds the $2,500 disallowed wash sale loss, giving her an adjusted basis of $12,000. Two things can happen at this point. If she sells the stock on May 20th, 2023 for $80 per share, the $4,000 loss will be another wash sale loss and continue to be deferred. Or, if she sells the stock on March 5th, 2024 for $80 per share, in other words, after the 30-day wash sale threshold has passed, she will have a short-term capital loss of $4,000. So what would happen if she didn't repurchase ABC stock within 30 days of the original April 15th, 2023 sale? The wash sale loss would then offset any other capital losses for that year, reducing the capital losses she can use to reduce other income. Fortunately, all brokerage firms have computers that keep track of these transactions and potential wash sales. Now let's look at Janet's brokerage statement and show how the wash sale is reported on her tax return. Here is the total of all the short-term transactions Janet had for the year. In this case, we're going to assume Janet didn't purchase replacement stock from her April 15th, 2023 wash sale. As a result, there is $2,500 in the wash sale disallowed column. Now, before Janet puts the figures into her tax return, she checks the math on the statement. Sometimes the net loss in the rightmost column reflects the disallowed wash sale, and sometimes it doesn't. On Janet's brokerage statement, it doesn't. Therefore, she enters the amount from the brokerage statement on Form 8949. In the adjustments column, she enters a W and enters the total disallowed wash sale next to it. This amount then reduces any other losses she had or increases any gains. If the brokerage statement already reflected the disallowed loss in the net gain or loss column, the figures can go directly on the appropriate lines on Schedule D without any adjustment. This is a very oversimplified description of wash sales, and of course, there is more to them than I've covered in this video. Additional information and resources can be found in the video description. If you found this video informative, liking the video and subscribing to the channel really helps more people find this video and benefit from it. As always, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of Your Taxes Oversimplified.